And now for the table of knowledge. Okay.
We've got an exciting one this week.
Okay, so we are being sponsored for the first time with real sponsorship, and it is thanks to Mark Anthony Bathrooms. Now, Mark is a friend of mine. In fact, he's Kim's husband, my best friend Kim's husband. And a few weeks ago, we were having a few glasses of wine and he said, I really want you to do R is for retirement and I'm happy to sponsor it. So I'm like, okay, if you want to do that, that's totally fine. And he's come through with a list of questions that I can answer around retirement on behalf of Mark. So I just want to point out, though, that I am not Mark's accountant. So I am kind of going to be answering these questions in a very general way. So even though I'm talking about Mark, I don't really know his financial affairs. So this information is very general and it will be answering the questions that Mark has asked from a perspective that I actually don't know.
Which is good. That's good.
So it could be something that is applicable to your situation. It could be applicable to someone you know. I am getting a lot of questions about retirement at the moment, and I think part of it is purely as an accountant, you tend to deal with people who are around your age, a little bit older, a little bit younger. I'm now 54. Oh, God, I can't believe I just said it. I'm 54. And so some of the people who I'm dealing with are in their 60s or getting close to 60 and starting to think about retirement. Now, it doesn't mean they're going to retire right away, but they're definitely starting to ask those questions. And I know that's what Mark is wanting to know. So
absolutely. And Mark, I've got the email from Mark where he's got these questions and he has said that he's interested in retirement on, as a small business owner. So this is probably good for a lot of listeners that do have those small businesses that kind of go, well, what happens to my business if I want to retire? So.
And before we start, because I'm going to get you to ask me the questions that Mark's asked, I just want to say retirement is a bit of a loose word these days. So back in the old days when, you'd get to 60 or whatever it was and you get the golden handshake and you would leave with your big gold watch and you'd go and play golf and never work again. It's kind of not really the situation anymore. A lot of people do retire like that, but there's also a lot of people who just sort of move into a retirement phase. They don't necessarily stop work altogether. People are still working well into their sort of 70s, even 80s. So there is no official retirement age. Often people try to align that to the age of the age pension, which is around 67, or when they can access their super, which is potentially you can access your super at 60. If you're 59, you might be able to access it now, but it'll be 60 for most of us. Better benefits at 65, whatever. So there's no real official retirement age. It's probably when you can afford to do it and when you also feel like you want to do it.
Definitely. All right. Should we get into the questions, Joe? All right. So first one off the rank. Mark has asked, what should I do with the business, especially when there are funds and assets such as motor vehicles and cash in the business?
Okay. Now, I do know that Mark trades out of a company, which I'm pretty sure he does actually. I don't even know. I'm pretty sure he does. But I'm going to assume that he trades out of a company. So and again, this is something I am finding with a lot of clients. I'm talking about the same stuff to lots of people. A company doesn't have to stop the day you retire. So usually what we would be suggesting is, yes, I want to wind down my business and maybe I want to stop altogether, but the company can continue to go. You will have some assets in there, and if you want to, you could go through a formal liquidation process to get that out, or those assets out, potentially move them out first, right? So you'd probably move your cash out. You'd probably move any assets like cars and stuff out, but you will have retained earnings and probably franked dividends that could be paid, and it could be very costly to try and do that all in 1 year. So I would typically suggest that you keep the company open for a few years at least as you start to systematically move the assets out of the business in the most tax-effective way.
Perfect. Next question, which is probably a really good segue from that one. What happens to the depreciation on the current assets?
Okay, well, it really would continue. It just might not have anything on the other side of it to be deducted against, and it really depends on the time. If you currently have assets and you're in the small business regime, which I'm pretty sure Mark would be, he probably actually has fully depreciated all of the assets in the business right now. So there would be nothing further to depreciate. If he starts buying stuff next financial year, he would have to start depreciating those assets if they're more than $20,000 because we've just had the budget. But you can continue to depreciate them. The problem is that if you've got no income on the other side, they're not really depreciating against anything. So it's probably just a paper thing that's happening there. There's really not that much you would do. The depreciation could potentially be offset against any income if you were to sell those assets. But yeah, I sort of think it doesn't make that much difference realistically from a depreciation perspective.
So in regards to some of those assets and particularly motor vehicles, is Mark able to transfer the motor vehicles under that company into his own name personally?
Yes, he would. So he'd have to go to the motor registry and pay stamp duty to transfer that out. Or Revenue New South Wales it would be, but wherever you are, if you're in a different state. You would need to do that at market value. You can say whatever it is that you want to put on there, but you're going to pay stamp duty on it. So if you don't put a reasonable market value on it, the Revenue New South Wales will know that you're transferring it at a lower than cost value or lower than market value, and they will come back and tell you that you can't do that. That would potentially be either a dividend that you might have to take out of the company or a repayment of some sort of shareholder loan or something like that. But yes, you would be able to transfer it out. The company would recognise that as income. So even though you might not have to physically pay that money, you would be recognising that that asset has been sold at that market value.
Perfect. And I know we touched on the instant asset write-off a little bit earlier when we were talking about the budget, but Mark wants to know if he should be taking advantage of the instant asset write-off.
He probably has. If you're going to be retiring, I don't see that it's going to make any major difference because ultimately, if you're still working, it's only an advantage if you're making money, right? So the instant asset write-off is only going to be a deduction against income. So if you've got no income, it's a deduction against nothing. You know, it's still nothing, right? I guess it really comes down to the circumstances. Yeah, sure. If you've got income there, take advantage of the instant asset write-off. Make sure you do it before the 30th of June for the full value, or after that it's only up to $20,000. So, but yeah, I would think that it really comes down to timing, what's the available law at the time. But yeah, you would do it to reduce your income.
Definitely. All right, so Mark, next question. He has asked, can I continue taking a wage or draw down dividends from funds to avoid paying workers' compensation?
Yeah, great idea. Okay, so yes, so the difference between those two things. Wages will attract workers' comp. You could, and again, it comes down to the income of the company. You could draw a director's fee and say that you're a retired director and you possibly can get away from workers' comp on that. However, I would certainly think if you have stopped trading in a company and you have funds available in the company and you have the ability to draw franked dividends, that would be the better option because so a wage is a tax deduction to the company. If you've got zero income and you're getting a tax deduction, all you're doing is creating more of a loss. It's also reducing the ability to draw a franked dividend if you've got a bigger loss because you can only draw a franked dividend based on the retained earnings in the company. The alternative is to draw that franked dividend. It is not a tax deduction for the company. It's just taking some of those previous profits out. It's not subject to workers' comp. It's not subject to superannuation guarantee. And you will get those franking credits. So that would be the preference if you're not trading anymore.
Talking about franked dividends, yeah. Mark would like to know if you can give a rough explanation on how franked dividends help in retirement and if or how they are possibly returned to him as a tax refund.
For sure. Okay. The company will have paid tax at currently 25%. In the past, it's probably paid tax at 30% and then reduced down. So what it does is along the way, and I know Mark's been trading for a few years, so he would have quite a few years worth of banked up franking credits there. In your tax return, your accountant should have a franking balance in your tax return, and it will tell you all the tax that you've paid in the past. So it's like an accumulation of all of those tax credits, all the tax that you've paid in the past. It's not GST, it's income tax. Now, that gives us the ability to know how much franked dividend we can draw. Okay, so we can only draw what we have franking credits for, and the other thing that we have to keep in mind is retained earnings. So we were talking about those two things, we've got to look at that. What happens is if we draw a dividend, and we can choose how much we want to draw as a dividend, we don't have to draw the full amount out, those franking credits get applied to the actual dividend that's being drawn. Now, let's take, I'm just trying to think of a really good figure that we can use that's nice and easy with 25%, and I think it's $7,500 dividend might be the way to do it, because that then grosses up to 10, right?
Yeah.
Okay, because otherwise you can be whatever it is. So the way to work out what the franking credit is on a dividend is you take the amount that you've drawn and you times it by 25 and divide it by 75, and that will be the franking credit. Now, if you were to draw a dividend of $7,500, then and we times it by 25 and divide it by 75, that should come up to $10,000, like $2,500, which is all up $10,000. And hopefully I've done that maths right in my head. Okay, so we draw a $7,500 dividend. In our tax return, we're going to put in our tax return that we have $10,000 worth of income, $7,500 worth of dividend, $2,500 worth of franking credit equals $10,000. We're going to be taxed on $10,000, but we're then going to get a credit on the other side for $2,500. Mm-hmm. Now, if you're in retirement, your tax rates are likely to be lower because you're not earning as much other income. If that's all you've earned for the year, if all you've earned is that $7,500 plus it's $10,000, the tax on $10,000 of income is zero, but you're going to get your $2,500 back. So you're actually going to get that money back. Essentially, if you can keep your income less than $45,000, which is where the tax rate goes to 34.5%, you're going to get a little bit of a tax advantage out of the franked dividend because you're going to get the credits back at a lower rate than the marginal tax rate that you're on.
Yeah.
And the reason it's good in retirement is because you're probably earning less money.
Yeah, exactly right.
Okay. Yeah.
All right, so a super question. Mark has said he's intended to draw down from his super retirement fund tax-free also. Now, he has said... I guess he's questioning, is it still the minimum 4% as stated by the government from next financial year?
Yeah, so it does depend on your age. The minimum is 4%, but it will go up as you get older. So it depends on your age. If you want to check what the age is for your particular circumstances, just Google minimum pension amount or something, percent, right? And it'll come up with it. So at the lowest level, which is 60, it is 4%. Now, up until this financial year, the end of this financial year, because of COVID, they actually gave us a half of that. So if you have been getting a pension from anywhere, you'll probably find that it will double from the 1st of July. So I know I was talking to my mum and dad about this. They get some pension out of their super fund and they're going, oh, it's not really a lot of money. That's because it's half of the percentage that is relevant to their age. Come 1st of July, it's going to double and they'll end up getting more money out. So yes, 4% is probably, well, I do know how old Mark is. 4% is the correct amount. And because you are 60, you would be able to get that out tax-free. If you happen to be drawing it this year and you're 59, you would be paying tax on it. But once you turn 60, that is tax-free. Bearing in mind the following. Okay, so that's tax-free to you. What a lot of people try to do is start a pension when they turn 60 with the intention of that pension becoming tax-free in the super fund as well, any earnings on that. That is the case if you're 65. If you're between 60 and 65 and you're not retired fully, as in you're still earning an income, that's called a transition to retirement pension. Yes, you can certainly draw 4% out, up to 10% if you're still working of your balance. But the superannuation fund will still be taxed on the earnings in your fund at that point in time.
So if that is happening, is Mark still entitled to receive the tax-free threshold of $18,200?
Certainly. But his superannuation pension would not even count towards that at all. He still has the $18,000 tax-free threshold for any other income he earns, yes.
Excellent. So any extra income that he receives from shares, rental income or any interest above the $18,200, is that income able to be transferred to their superannuation accounts to utilise the $27,500 limit each?
Yes, certainly is. So, again, there is a time when you can't do that, but that is not until you're around 75,000 years old. That's really old. So you're around 75. There are limits on that, but certainly at 60 you can still make the $27,500 contribution. You'd have to look at what income you're getting as to whether it's worth it, because there's no point paying when you make that $27,500 contribution. It would have to be to a separate fund or a separate account in your super fund. You can't contribute to your pension fund. It will be taxed at 15% when it goes in. So if you're earning less than $18,200 and getting taxed on zero, you wouldn't want to pay 15% tax on your superannuation contribution. So you may choose then to make it a non-concessional contribution, which you actually have at a cap of $1,100 to put in. So again, it's all probably a bit of thinking about what the situation is. How much am I earning? Is it worth taking that tax deduction for it? Because I don't want to pay 15% tax on something that I'm not going to get at least a 15% tax deduction for.
Exactly. No point paying tax if you don't have to.
Yeah.
And last question from Mark. He has said, if we want to go travelling for an extended period of time, can they rent out their house without capital gains tax as it is their primary residence?
Yes. Okay. Some qualifications to this. Yes, you can rent your house out. There's nothing to stop you from doing that. Will it become capital gains tax free? Yes, it will, provided you continue to be an Australian resident for tax purposes. So that's a big qualification there. And if you are in that position where you're going to move overseas permanently, you would definitely need some tax advice on that. If you decided to go overseas for a couple of years, come back, then come and move into your house again, and then, essentially, if you are allowed to continue to call that main residence your main residence for 6 years after you've moved out of it before capital gains tax will take place. So assuming you don't have another main residence in Australia, if you're travelling around for maybe a year or two, come back, move back in, you wouldn't have to pay capital gains tax. My concern is that if you were overseas and had established permanent residency overseas in some capacity and became considered a non-resident for tax purposes, the capital gains tax regime, you actually lose your entire main residence exemption on everything, the whole house, not just from when you moved out, from the time you bought it. So it's really important if you're moving overseas that you get tax advice on that, because it could be a horrendous amount of tax to pay. So yes, definitely can go overseas, travel around a bit, come back, be an Australian resident for tax purposes when you sell it, and retain that capital gains tax exemption for up to 6 years, but not if you're an overseas resident at that point in time.
Yeah, it sounds like definitely something you want that little bit of advice on, because you don't want to get caught out. Yeah,
it's actually a very punitive arrangement that came in a couple of years ago that's caused a lot of controversy for expats. You lose even if it was a pre-85 asset, you're still going to lose exemption on that. Yeah,
interesting.
So, I'm pretty sure that even if it's pre-85, but essentially, you lose any main residence exemption on it.
Very interesting.
From the time you bought it. So.
Yeah.
All right. Well,
That's
hopefully
it
that's answered your questions, Mark. And if it hasn't, I'm happy to have a glass of red or white and we can go over them again. But, I thank you so much for sponsoring our episode 2. It's actually
Thank you, Mark.
allowed us to buy a new microphone, which we're very excited that we'll be using in a couple of weeks, because we're going to have 3 of us on the podcast for a few weeks. Thank you.
Thanks, Mark. Big shout out.
And we will put, if anyone is interested in getting their bathroom done from Mark, he's in Sydney, we will have some links in the show notes on how you can get in contact with him.